Friday the 25th of June 2021, De Grey Mining came out with their maiden resource for their Hemi project in Western Australia this week on Wednesday. I hadn't been fully across this stock for the last few months, and I keep a bit of an eye on some of the drill results, but never digging in with too much detail. And I didn't realise this resource announcement was due relatively soon. I thought it might be toward the end of this year, but as I said, I haven't been keeping fully across the stock. So I thought I'd just go through some things that I saw in here, and with a view toward the scoping study that's going to be released in the next quarter, they said, which I think is a key announcement. So first off, the headline was above what I had sort of thought. I mean, I hadn't really, I find resource estimation is always a bit of a dark art, and it's not easy to do that. But in my head, I had sort of maybe at that 4 or 5 million ounce mark. So to get a 6.8 million ounces, very good number there. So I've got no issues with that. But I think it's all about quality of ounces. And that's the bit it's very difficult to tell without some economic studies for the project. So I guess the other thing that stood out to me, aside from, you have a very high ounce figure, but the grade is very low. I think maybe the market had expected a higher grade. We only got 1.1 grams at a total level, 1.3 for the indicated portion of the resource, which, to have an indicated portion in a maiden resource is pretty good. I mean, they have been doing a lot of drilling. They're well funded after that large capital raising last year. So that's enabled them to do a lot of drilling and have a high proportion of indicated in the maiden resource. The other thing, I guess, the cutoff grade, I'll talk about that a bit in a second. I think that's relatively important, but I can dig into that in a bit. And then they've got their other resources in the project. Remember, they already had existing resources before Hemi was discovered that were sort of sitting there, not valued very highly by the market, partly because I think of the refractory nature of the ore bodies. They didn't have any reserves in the project as well. So I'm not, at this stage, I'm kind of uncertain about the ability to extract that gold in those other parts of the project and what the economics are. I mean, that's the big question mark. So as I said, these mineral resources provide a strong platform for a scoping study targeted for completion in the September quarter. So a scoping study is going to be that very high level detail. A lot of companies have had issues releasing scoping studies on the ASX. It's not well liked by the market regulator, I think. So they have to be careful there. But I'm sure it looks like they want to show some big numbers here about what the potential for this project is. I saw this Hemi contains over 25,000 ounces per vertical meter in the shallow, better drilled portions of the resource. I mean, I see this ounce per vertical meter number all the time, and I'm never really sure why it's included, especially when comparing ore bodies. I mean, Hemi contains, I think, 5 or 6 ore bodies within the project at this point. So obviously, if you have a large area, you're going to have a large number of ounces per vertical meter. So it's when you've got multiple pits, it's not a very useful measure. Often it's a useful measure for underground, where you've sort of got you can mine that more easily if it's in a concentrated area. So I'm always a bit skeptical about this measure, and it doesn't really provide any value. They've talked about tier 1 scale. I think that's probably true on an ounce basis. What we've discovered in the ground here is tier 1 scale. I guess the question is, can it be a tier 1 production? Because as I said, you do have that low grade and complex metallurgy as well. So that's going to be the interesting thing from the scoping study, how much they dig into that. Here's the sensitivity to the cutoff grade, which I think is quite important. Often, I think in the indicated portion, you can see that it's there's not much sensitivity to the cutoff grade. So they've used a 0.3 gram for the headline figure, which I think is quite low, especially considering that this ore body is refractory. All of that refractory processing, which I'll talk about in a second, and I've mentioned before, requires a lot more energy. It requires a highly complex plant and OPEX costs associated with that plant. So whether they can get the cutoff grade is going to be anywhere near that. I was looking at the Gold Road resource at Gruyere, which I think is a relatively good analog. here in grade terms, and the Gold Road resource is at a 0.4 gram cutoff. So I'll talk about Gold Road in a bit as well. So I think that's quite good sensitivity on the indicated portion there. Does drop away a bit more on the inferred portion of the resource. So that's something to watch out for. But it's not. I think below 370 meters as well. To include those resources is a bit, particularly even at a 1.5 gram cutoff, it's going to be, it's going to be pretty marginal sort of ore, I think, down at those depths if you're talking open pits here, or even if it was underground. It's going to be difficult to produce economically from those ounces, I think. So they've said here, project studies, as I mentioned, that September quarter. The aim of this study is to demonstrate the project's ability to deliver a tier 1 production profile. And I'm sort of the aim of the study should be just to demonstrate what it's capable of. Whether that's tier 1 or not is sort of a bit of a. I don't want to make the company out to be that maybe they're reaching for something here. I think that's the studies should tell you what they tell you, not that you're almost preempting the outcome of the study there by saying that. So that's always a bit of a warning sign. And I think that study will have a big number attached to it to really try and excite the market. The key for me, and the times I've talked about this stock previously, it's all about metallurgy. There are other projects like this that have been discovered worldwide that have never been mined because of complex metallurgy. And I think some in the market don't really understand this. The pressure oxidation technology that is being proposed for De Grey has never been used in Australia. There are only maybe a dozen plants in the world that use this, gold mines. So it's highly technical, and I can't state that enough. That's very, very important, that the difficulty in implementing this technology and doing all the test work and everything is extreme. So I think there needs to be a bit of assessment by some who are still stuck in this sort of geology game where you're talking about number of ounces and giving a valuation per ounce and all this sort of stuff to justify it. Technical stuff doesn't work like that. It's you can't compare a project with Gold Road's project to this, because this is a highly complex area that needs to a lot more work done, and that means a much longer timeline to get into production as well. So I've done some numbers. First off, I'll just talk about Gold Road. I was just having a look at one of their latest presentations. Gold Road owns half of Gruyere. The market cap of Gold Road is a little bit out of date, a couple of months old now, but the market cap is about 1.2 billion Australian dollars, but that includes $150 million in cash, and they have also paid out a dividend recently as well. So call it about $1 billion Australian is the value of the enterprise value of Gold Road. So the Gruyere deposit, if you were to use that, the whole plant, which cost $620 million to build after a revised Capex, that whole plant and the value of Gold Road share and Goldfield share is about $2 billion without any debt attached to it. So if we look at De Grey mining, the market cap of De Grey at the moment, I believe, is in the order of 1.5 billion Australian dollars. Obviously, they'll still need to do a lot more drilling, a lot more studies. They've got a healthy cash balance, about 85 million. But this is the game I play. If you're talking about the $1.5 billion stock versus a $2 billion mine, if we take Gruyere Limited, if we just imagine that was a single company, the value of that company on current valuation of Gold Road would be 2 billion Australian dollars, the enterprise value. So that shows you potentially how I think De Grey is mispriced in the market. I don't have any issue with, it's a huge resource, but when you compare it to an existing mine that is completely de-risked, I think that's a key. And Gold Road's ramping up toward 350,000 ounces production and a 10 million ton plant in the next couple of years. So this is a significant operation. It has all-in sustaining costs about 12 or 1,300 Australian dollars. So that's another thing to keep in mind, which I'll talk about. And also, if you look at the resource for Gruyere, probably in the ballpark of what we have at Hemi so far discovered, 5.73 million ounces open pit, and some underground ounces as well. A little bit similar to the underground ounces are another 900,000 ounces roughly, but pretty similar to, I think, to Hemi in that they're not that economic at that grade and depth for underground. So that gives you a ballpark of what Gold Road or what Gruyere is worth, and I think there's a little bit of mispricing going on here for De Grey. And if you look at if a company, it's pretty obvious with the 1.5 billion market cap, there's a lot of and the need to spend. Now this is I guess what's going to be the key point in the scoping study. I've tried to run some numbers here. I think potential. So I've put 3 scenarios: 6 million ton per annum mill, 8 million tons, or 10 million tons. I think this, on the scale of what we've got so far, a 10 million ton operation is entirely possible here. And the thing is, you're going to need this large scale because of the grade. So if you really want to get to a tier 1 production status, that term tier 1 is very overused and means different things to different people. But I think it really needs to be in that, getting close to sort of 350 to 400,000 ounces to be a real tier 1 mine. And that's probably about the order of some of the larger mines in Western Australia, owned by companies like Northern Star with Jundee is about that order. Gruyere we've talked about. Tropicana is in that sort of 400,000 ounces plus range as well. So that's kind of the tier 1 status I think that is required. So from a Capex point of view, and this is excluding the POX part of the plant, the pressure oxidation, I think you're talking Capex. I've estimated, just based on a bit of rough numbers and looking at other feasibility studies previously, I think at Australian dollar terms, you're looking at about a $600 million plant for a 10 million ton plant. Now, the issue here is POX, so the pressure oxidation, and where this comes in is because of the refractory nature of the ore, they need to have a POX circuit. And they've said previously that because of the metallurgy here, they can get that into a concentrate, so they can concentrate it down to about 10% of the initial. I think it's even maybe less. They've talked about a 1 to 15 to 1 concentrate, I guess. So the size of the POX concentrate circuit might only be about 600,000 tons per annum. Now, I've looked at some of these. There's some Russian companies that have built POX plants in the last 10 years that have quite a lot of data on their websites, and you can have a look at some of their presentations. This one, I've looked at this slide last year as well, I think, and they estimate the capital intensity. This is a pretty small sample size, but it's a pretty small a pretty small selection of companies that actually have this technology. I've used the Petropavlovsk numbers here, which is where this presentation's from. $620 to $775 per ton if processing concentrate, and that gives some numbers in this order here in Australian dollar terms, about 500 million Australian dollars to 600 million at the low and high end to build a 600,000 ton per annum POX circuit. So, and this is a relatively recent project in the last couple of years. The POX 2 from Polymetal, that I actually just bought some shares in Polymetal, and I'll do a video on that probably in the next couple of weeks. That's a much higher capital intensity, but I've used this Petropavlovsk number because I think the scale is probably more in the order. But obviously, there's a lot of technical stuff here as well that it may not be able to be directly compared. But needless to say, it's an incredibly expensive exercise to build one of these plants, and as well as all the technical implementation as well. So you're talking, I think, and in the order of $1 billion to build a 10 million ton plant with a POX circuit around this size. So these are big numbers, and that's when I talk about comparing Gold Road to De Grey. That capex that it's required to build this thing, you might have a 1.5 billion market cap. You're still going to need to raise $1 billion to build this project. So, these are big numbers here. So the market cap really needs to adjust for that capex, and I'm not sure if it really has hit yet. I know I saw one broker estimate was estimating about $800 million Australian. I don't know what size of plant they were looking at for that. I mean, I last year I was looking back at some of the estimates I had done, and I sort of thought potentially in the order of 750 million to $1 billion Australian dollars to build this at kind of, I was probably more looking at this 6 to 8 million ton range. So it's probably, the estimates here are probably in line with what I had thought then. So I'm really interested in what that scoping study delivers. I've no doubt that it'll deliver big numbers on the ounces in the ground side and the production potential, but that Capex number is very important. And also the OPEX. I think the broker estimate I read was they're looking at sort of just over 1,000 Australian dollars, maybe 1,100 Australian dollars as operating cost, all in sustaining cost. I don't really see how that's going to be possible for a mine that's producing at 1.2 grams. That's almost identical to what Gruyere has. If we're looking at this 10 million ton scale, again, very similar to Gruyere. Gruyere is producing at about 1,200 to 1,300 Australian dollars at the moment and doesn't have any of the refractory ore body that we have at Hemi here. So you're going to need all that there's not only additional Capex associated with the POX, but also a lot of OPEX because it's very high energy, high temperature, and high pressure. So that could easily add a couple of $100 an ounce. So I think you're looking more in that. My feeling would be in that 12 to maybe 1,500 Australian dollars is the potential range for the all-in sustaining costs. But this is all very high level stuff here. But looking at other projects in Western Australia, very difficult to get all-in sustaining costs that low, even with such a high scale. Now, I said Gruyere, even Tropicana, the scale there, with the scale they've got, aren't producing at such low costs anymore. The industry has, particularly in the last 3 years, we've seen costs rise quite a lot. Companies like Regis, for example, as well, their open pits used to be highly profitable, well below 1,000 Australian dollars all in sustaining costs, but they've gradually been ticking up sort of $50 or $100 each year. So I just don't see how this can produce at such low levels as what that broker report said, under 1,100 Australian dollars. So that's just a feel. Obviously, there are some highly profitable parts of this ore body. Probably, I think the Brolga pit looks very good, but I've sort of, when I've looked at the drill results, they've been gradually getting weaker. Aside from some sort of some very standout name numbers that come out every so often, a lot of the results haven't been as good as what was initially found last year. So they're finding more ore bodies, but I think the quality is kind of diminishing. So it's going to be at about that balance between scale and cost here, and Capex as well. So I'm really interested to see this. I follow this stock because I like the highly technical sort of nature of what's going on here, and trying to sort of work out the mystery of what this is going to be producing at. With these numbers, it looks like it has the potential to be a mine. It should be, if you've got that much ore in the ground, it should be a mine. But we've seen metallurgy to be a big problem in the past for these sort of companies. I've talked about Cardinal Resources. I know a number of people on the channel held that back in 2016 when they released their maiden resource and had the metallurgy in there. And we saw this last year with De Grey. They came off, but the project gradually had to be altered to accommodate that sort of weaker metallurgy in the Namdini ore body and lower recoveries. But here we're going to have to build significant amount of extra plant to process this ore. And I note that the Namdini feasibility study had the Capex in the order of 400 million US dollars for a 10 million ton plant. So close to what we have here in that sort of 600 million Australian range. So that's kind of where I'm getting that number from, as well as the Gold Road figure of 620 million from a few years ago. So that's where I'm getting the Capex from. Chart-wise, the stock's had a couple of interesting days. It's really sort of a bit of a battle here between bulls and bears. It fell quite heavily on the day of the release, opened up high and had that sort of big engulfing candle. But then after, I guess, a bit of news came out from the brokers, had a nice move up yesterday, and then on Friday got sold down again. So it's really a bit of a battle here to make a move and make the next move. But you're starting to fight that Lassonde curve here, where we're moving up to a new high here. But after we get the maiden resource, that's often the point at which these companies sort of struggle to keep the momentum going. And I think that the timeline, I won't dwell too much longer on this, but I was looking at some of the other things in this. This is a polymetal presentation from there. They're one of the key proponents of POX in Russia. They built a plant and then building a new plant now. And you can see here they've got some key takeaways about POX versus some of the other technologies for processing refractory ore. Complex, requires vast technical expertise. Now, this company has its own engineering company associated with it. They own a company that's basically built their own processing plant and designed it, or partly designed it. And if you look at some of the other companies employing this technology around the world, we've got Newcrest, Newmont, Barrick, Agnico Eagle. These are in the top 5 companies in the gold industry. And then we've got a couple of the upstart Russian companies, Polymetal and Petropavlovsk, which I talked about. The only other companies that have really in the mid-tier space employed this technology on this list anyway, Alasa, which is now SSR Mining, and Oceana Gold in New Zealand. So it's not widely used. It's highly technical, and it's not just about geology. This is more a chemical operation. It's more like a smelting sort of operation, highly complex. If you look at some of there's some good pictures in here of the POX facility for that is with Polymetal. All of this is a large chemical plant. They've got an oxygen plant. They've got 2 oxygen plants here because they're building another one. This is highly technical and extremely costly. I mean, some of the Russian plants are in very harsh environments, but that's not what's setting the high capex in some of these projects. So I think there's quite a good amount of information. As I said, this company in here, they've got their own engineering department, an engineering company which they use. They've built these plants before, and their plant that they're building now, it costs $430 million US. And you can see here how long it takes. They've started detailed engineering in mid-2019, and it's going to take 4 years from then to full ramp up of the plant. So this isn't your average, 2 or 3 million ton mill in Western Australia that gets built in 12 months. This is a highly complex and lengthy exercise. And before you get to this point where you can start detail engineering and construction, you've got to do a lot of work on test work. Much longer than you would have for a normal processing operation. So, Alasa, I was looking at some of their timelines today, and they really spent probably 5 years before they went to financing and to build the plant, and then another 2 or 3 years to build it before production. Partly that might have been due to financing difficulties in a gold sort of bear market, but still, Polymetal doesn't have any financing difficulties. They're a large producer, and it's still taking them 4 years to go from detail engineering to ramp up. So this is going to be, I think that this is important from a Lassonde curve perspective. That technical phase of the Lassonde curve where you're doing feasibility studies and test work, that's going to drag on for a long time for De Grey. So that's something that's sort of a fight between. You're going to be probably trying to release more and more drill results to keep the share price up and to improve the scale of the ore body and the confidence levels, but it's going to be fighting all these other technical studies which are going to drag on for quite a long time. And I think when you look at that list of companies, to me it stands out that De Grey are going to need to get a partner for this project. They need one of these large gold producers is going to be one of the things they need. I think that's something that Gold Road did very well when they built Gruyere. They brought in Gold Fields. They understood their weakness, Gold Road. They were a geology company. They were good explorers, but they were not in the business of building $600 million processing plants. So selling half that asset to Gold Fields, I've always thought was a very good move because it shows knowing your limitations, and it avoided some of the problems that we've seen in the gold industry, where a lot of companies that are run sort of by geologists, they move into production, they have huge issues in production, and the economics fall apart and the projects fall apart. We've seen this with companies like Dacian Gold. I note also that the former CEO of Dacian Gold a number of years ago was the verifying geologist on the Hemi feasibility study. That's not to say he had any problems with Dacian. He exited long before the issues evolved there, but I just thought, wow, it was an interesting point that he was involved in this geology for Hemi. So, that's another thing I try and look for with these resource announcements now. Find out who's verified it, where they've worked before, and if there's any red flags there are companies that have had problems with geology and moving into mining. So that's De Grey. It's another stock that I'll keep watching. It's not one that I hold, and I don't plan on holding it with such a lofty valuation. But I do find it interesting how it's evolving, and I'll keep following it over the next few months. Thanks very much.